Calculate and interpret key liquidity ratios. The current ratio measures short-term solvency by dividing current assets by current liabilities. It indicates the firm's ability to meet obligations due within 1 year. A ratio above 1.0 generally suggests adequate liquidity, but excessively high values may indicate inefficient asset utilization. Interpretation must consider industry norms and working capital structure. The Quick Acid Test ratio refines liquidity measurement by excluding inventory and prepaid expenses from current assets. Calculated as cash plus marketable securities plus receivables divided by current liabilities, it focuses on highly liquid resources. The cash ratio further restricts analysis to cash and cash equivalents only. The cash flow ratio evaluates liquidity from an operating perspective. It is calculated as operating cash flow divided by current liabilities, emphasizing actual cash generation rather than balance sheet values. The net working capital ratio expresses net working capital relative to total assets or sales, indicating the proportion of resources available for short-term operations. B. Analyze how changes in current assets, current liabilities, or sales affect liquidity ratios. Liquidity ratios are sensitive to shifts in working capital components. An increase in accounts receivable raises the current ratio but may not improve actual liquidity if collections slow. Similarly, rising inventory increases the current ratio but does not improve the quick ratio. Changes in current liabilities significantly impact liquidity measures. Paying off short-term debt reduces current liabilities, increasing liquidity ratios, while new short-term borrowing decreases them. Managers must assess whether ratio changes reflect genuine improvement or temporary balance sheet timing. Sales growth affects liquidity through working capital demands. Rapid sales expansion may increase receivables and inventory, potentially straining liquidity if not matched by efficient cash collection and turnover management. Calculating the numerical effect of these changes allows managers to anticipate funding needs. C. Demonstrate understanding of the liquidity of current liabilities. Not all current liabilities carry the same urgency or liquidity risk. Accounts payable may offer flexible payment terms, while short-term notes payable and accrued interest often have fixed due dates. Understanding maturity structure is critical to evaluating real liquidity risk. Some current liabilities require cash settlement, while others may not. Unearned revenue represents an obligation to deliver goods or services rather than pay cash, affecting liquidity differently than trade payables or short-term borrowings. Effective liquidity management involves matching cash inflows with liability maturities. Managers must evaluate the timing of expected operating cash flows relative to due dates of obligations to avoid cash shortages, ensure solvency, and maintain financial flexibility. D. Define solvency and distinguish it from liquidity. Solvency refers to a company's long-term ability to meet its financial obligations and sustain operations over time. It focuses on overall financial structure, debt levels, and the firm's capacity to generate sufficient earnings and cash flows to service long-term liabilities. Solvency analysis evaluates whether the company can survive economic downturns and honor debt agreements without jeopardizing its viability. Liquidity, in contrast, addresses short-term obligations due within 1 year. While liquidity ratios measure immediate cash sufficiency, solvency ratios assess structural financial risk and long-term stability. A company may be liquid but insolvent if it can meet short-term bills but carries excessive long-term debt. Understanding the distinction is critical for financial decision-making. Liquidity problems often signal operational issues, whereas solvency concerns relate to capital structure, leverage strategy, and long-term risk exposure. E. Define operating leverage and financial leverage. Operating leverage measures the extent to which a company uses fixed operating costs in its cost structure. A higher proportion of fixed costs relative to variable costs increases sensitivity of operating income to changes in sales volume. Companies with high operating leverage experience greater earnings volatility when sales fluctuate. Financial leverage refers to the use of debt financing to increase potential returns to shareholders. By borrowing funds at a fixed interest cost, firms can amplify returns on equity when earnings exceed financing costs. However, financial leverage also increases risk because interest obligations must be paid regardless of profitability. Both forms of leverage magnify risk and return. Operating leverage affects business risk through cost structure, while financial leverage affects financial risk through capital structure decisions and debt obligations.